It's certainly been another eventful quarter, and a period where markets appear to have again been dominated by central bank policy, where both the Bank of Japan and the European Central Bank in a state of ultra-loose monetary policy, with the ECB having begun its long-awaited outright bond purchasing program at the start of March. On the other hand, the US Federal Reserve has brought its asset purchasing program to an end, and is increasingly indicating its desire to at least begin the process of policy normalization over there. But clearly these actions, in our view, were the major driving force behind markets over the quarter, with strong double-digit returns from both European and Japanese equity and bond markets, while the US equities really struggled to make any progress. Following a fairly disappointing 2014, UK equities delivered a pretty respectable 4% over the past quarter, whilst global equities returned a healthy 7.5% in sterling terms, helped in part by the strength of the US dollar. And looking at emerging markets, despite very different individual country performances, emerging equity markets as a whole returned a solid 7.3% in sterling terms, so matching the performance of developed equity markets. And finally, bond markets, perhaps unsurprisingly, benefited almost universally from a drop in European yields, as well as a fall in inflation brought on by last year's collapse in oil price. UK government bonds followed with a pretty impressive 2.3%, which, considering its stellar performance last year, is a good return. Credit's been lagging a little of late, but still produced good returns over the quarter. The first quarter of 2015 has been a reasonable period for our diversified target return fund, returning 2.6%. Asset allocation decisions dominated returns over the quarter, with a roughly even split between our equity and our fixed income decisions. So starting with equity, it's our allocation to quality-orientated stocks that was the largest contributor, followed closely by our allocation to emerging equity and to UK stock market. Within fixed income, the fund's exposure to convertible bonds led the way, and it was further enhanced by our emerging market debt exposure and our exposure to high-yield credit. Now, with most markets drifting upwards of late, our view on valuations has not changed materially, and as a result, we haven't seen the need to make significant alterations to DTR's positioning. We did trim back our infrastructure exposure, and we rotated some of our floating rate loan exposure into fixed rate high yield, given the relative attractiveness of the one asset class over the other. The diversified target return fund remains well allocated in our view to a balanced mix of strategies. We hold just under a third of the portfolio in equity, predominantly in global and quality-oriented companies, with the remainder of the portfolio invested in a number of fixed income strategies, with high-yielding credit, convertible bonds, and hard currency emerging market debt being the largest positions from a risk point of view. Markets will remain dominated, in our opinion, by central bank action in the months ahead. While the Fed's on course for raising interest rates in the near term, it's at the same time revised down its growth and inflation forecast. I think it's dramatically lowered its future interest rate expectations too. So it seems that lower for longer remains the mantra, and weaker jobs growth seems to have increased the possibility, although not the probability, of no interest rate rise this year. At the same time, there's no doubt that the ECB and the Bank of Japan will keep policy ultra loose, and the Bank of England has put back its first rate rise until, well, almost certainly until 2016. I think the world remains awash with liquidity, which will keep bond yields exceptionally low and, in our view, highly unattractive, whilst continuing to provide an underpin for equity markets. But look, clear risks remain, and although we don't foresee a renewed bear market on the horizon, I think there'll undoubtedly be periods of consolidation and bursts of volatility. So position sizing, risk management, diversification remain of utmost importance.